Welcome to Know What You Are Investing podcast, where we decode the world's top companies, what they do, how they grow, why it matters. In this episode, we're diving into Tesla's Q3 2025 earnings recap, a quarter defined by record vehicle deliveries, robust cash flow, and bold bets on AI and autonomy. We'll break down the key metrics, explore Tesla's business segments from energy to Robotaxi, and discuss what these developments mean for investors. Let's get started. Welcome to the Deep Dive. Today we're looking at Tesla's Q3 2025 earnings. And it's more than just a review, isn't it? It feels like both a progress report and maybe a declaration of a huge strategic change towards AI and robotics.
Yeah, our mission here is to figure out how they're doing both things at once, delivering these record operational numbers while also launching this incredibly ambitious plan that really changes what Tesla is.
Yeah.
We need to look at the financials, the cash that's funding this whole vision of what they call it, sustainable abundance.
Exactly. And that framing is crucial for understanding this quarter. Because if you remember Q2, the management tone was pretty cautious, worried about tariffs, the economy.
Right.
But Q3, it felt different, much more assertive, confident. They seem really clear internally about how fast they think they can scale up production and autonomy, even with those, near-term cost issues they acknowledge.
Okay, so let's look at that foundation. What supports this confidence? The top line numbers look good. Total revenue, $28.1 billion, up 12% year over year. Yep, 12%. And non-GAAP net income was $1.77 billion. So yes, selling more stuff than ever.
But you mentioned before we started, the real story isn't just revenue.
No, I think the power metric here is cash generation. That's the fuel for the AI ambition. Free cash flow, or FCF, that's the cash left after running the business and paying for new equipment and stuff. It hit a record, almost $4 billion.
$4 billion, wow.
Yeah, and that's up something like 46% just from the previous quarter, sequentially.
Okay.
And all that cash means their balance sheet looks really strong. Total cash and investments, that grew by nearly $5 billion, $4.9 billion, hitting $41.6 billion overall.
$41.6 billion.
That's the ample firepower they keep talking about. It's what pays for the cybercab factories, the Optimus development, the AI supercomputers.
All right, let's try to unpack this then, because it seems like a bit of a paradox. Record cash flow, fantastic, but profitability metrics are getting squeezed. How does that work? You have this huge pile of cash growing while margins are shrinking.
That's exactly the counterpoint, that margin compression. Operating margin fell quite a bit, 501 basis points year over year.
Okay, 501 basis points. Remind us what that means.
Right, so a basis point is just 1/100%. So we're talking a drop of just over 5 percentage points. The operating margin landed at 5.8%.
And do we know why? What's causing that pressure?
Yeah, they were pretty clear about the headwinds, over $400 million just from tariff costs. And that was split roughly evenly between cars and the energy business.
Okay.
Then you had fewer sales of those high-margin regulatory credits that it tends to fluctuate. And finally, OPEX is up. Both R&D and SG&A are rising because they're pouring money into AI development and, interestingly, costs related to the shareholder meeting prep.
So they're basically spending money now, taking the margin hit to build out this future platform.
That's the narrative, yes. Investing profits today for hopefully much larger platform profits tomorrow.
Okay, moving beyond the overall finances then. Let's look at the core engines, cars and batteries. You don't generate record cash without some serious muscle there. How did they do?
Oh, the scale is impressive. Vehicle deliveries hit another all-time high. 497,099 cars delivered.
Almost 500,000.
Almost. Up 7% year over year.
Yeah.
But maybe even more importantly, they got much more efficient. Global vehicle inventory dropped way down. Just 10 days of supply.
10 days. That's incredibly low.
It is, down 47% year over year. Means they're getting really good at matching production to actual demand, which frees up cash instead of having it sit around in unsold cars.
And what about the cars themselves? Any product strategy shifts?
Yeah, definitely a continued focus on affordability and just getting cars to more people. We saw them introduce the Model 3 and Model Y standard range models in the U.S., starting prices in the high 30,000s.
Right, trying to hit those lower price points, especially with tax credits changing around.
Exactly. And expanding geographically, too. They launched that longer wheelbase Model YL in China, which adds a 6-seat option. And, importantly, started delivering the Model Y in India.
India is a huge potential market.
Massive. And then there's the energy business. It's really becoming a major pillar, not just a side project. Management kept stressing how crucial energy expansion is for the whole AI future.
How so? What were the energy numbers?
Record deployments there, too. Energy storage deployed hit 12.5 gigawatt hours. That's a lot of battery capacity.
12.5 billion watt hours. Wow.
Up 81% year over year. And that side of the business generated a record $1.1 billion in gross profit.
Okay, so energy is really contributing now. How does that massive battery deployment tie into the bigger picture, the AI stuff?
Well, partly it's about enabling the grid to handle more renewables, which you need for sustainable energy. But they also made this interesting point about grid efficiency. They estimate that just by adding megapack batteries to buffer the U.S. grid, you could basically double the useful energy output of the entire country.
Double it, just by smoothing out supply from solar and wind.
That's the claim, by reducing wasted curtailment. And they're engineering the next generation, Megapack 4, to output at 35 kilovolts. Sounds technical, but the point is, it simplifies things hugely for utilities. It essentially builds the substation into the battery pack.
Vertical integration again, solving the grid problem so their future compute needs actually have power.
Pretty much. They need a stable, scalable grid to power all those AI data centers and eventually the cars doing inference.
Right. Which brings us to what the CEO called that critical inflection point, this idea that Tesla isn't just an EV and energy company anymore. It's becoming, or wants to become, a leader in AI, robotics, and related services.
Yeah, that shift in identity is front and center now. And it all hinges on cracking unsupervised autonomy, full self-driving.
And the update there was FSD version 14.
Yes, version 14 supervised started rolling out. And the key thing is, it brings a big chunk of the actual Robotaxi software stack, the more advanced stuff, down into the consumer cars people are driving today.
Okay. And what about the actual Robotaxi service?
Well, it's running in Austin. They mentioned passing 250,000 driverless miles there. And they just launched a service in the Bay Area, too.
Driverless miles, meaning no safety driver.
That's the implication for Austin eventually. They said they expect to remove safety drivers entirely from the Austin fleet within just a few months.
That seems fast.
It's incredibly ambitious. Their goal is to be operating robotaxi services in 8 to 10 cities by the end of this year. But that depends heavily on getting regulatory approvals. They mentioned Nevada, Florida, Arizona as key states.
Okay, let me push back slightly here. The text sounds like it's progressing, the rollout plan is aggressive. But the source material also mentioned that only about 12% of the current fleet actually uses the paid FSD software. 12%. Doesn't that suggest there's still a big gap in convincing people to pay for it, or maybe trust it?
That's a really important point. It definitely highlights the challenge. There's a difference between the tech existing and widespread adoption or reliance on it. And maybe that's why the underlying compute power, the AI brain, is almost more important right now than the current take rate.
The brain power, you mean the GPUs?
Right. They reported their AI training compute capacity reached the equivalent of 81,000 NVIDIA H100 GPUs, which is, a massive amount of AI training horsepower. And H100s are the top tier right now.
81,000, okay.
But the really interesting part is their own custom chip, the AI5. They're going for what they call radical simplicity and vertical integration. They're literally deleting parts other chips have, like the legacy GPU and image signal processors.
Why? Because they don't need them for the specific task of driving.
Exactly. They know precisely what their software needs to do, so they can optimize the silicon just for that, which allows them to make these huge claims, like AI5 being potentially 40 times better than the previous AI4 chip by some measures.
40 times? That sounds almost unbelievable.
Well, they tempered it slightly, saying, safely a 10x improvement. But even 10x is revolutionary. They're aiming for the best performance per watt, maybe 2 or 3 times better than competitors, and performance per dollar. Maybe 10 times better?
By controlling the whole stack, hardware and software.
That's the bet. That vertical control unlocks performance nobody else can match using off-the-shelf parts.
Okay, so AI compute is pillar 2. What about pillar 3? Optimus, the robot.
Right, the humanoid robot project. That continues. The goal is still ambitious. Unveil the V3 prototype in Q1 next year. And eventually produce 1 million units per year.
1 million humanoid robots a year. That's a lot.
It's staggering. And they gave some insight into just how hard it is. Management said designing the hand and forearm is actually more difficult than the entire rest of the robot, just from an electromechanical standpoint.
The dexterity needed, I guess?
Exactly. And maybe even more critical, they pointed out there's basically no supply chain for this stuff. You can't just go order parts for mass-produced humanoid robots. They have to build that entire supply chain themselves from the ground up.
So another massive vertical integration challenge. It shows the sheer scale of what they're trying to build way beyond just the robot itself.
Absolutely. It's infrastructure creation on a huge scale.
Okay, so looking ahead, how does this AI confidence change their plans for, say, car production?
Well, it seems to have unlocked more aggressive goals there, too. Now that they feel more confident about autonomy solving the demand side, they're aiming for an annualized vehicle production rate of 3 million cars within 24 months.
3 million a year within 2 years.
Yeah, and a big driver for that increase is expected to be the Cybercab. That's the dedicated Robotaxi vehicle, remember? No steering wheel, no pedals, just optimized for autonomy. Production for that is apparently slated to start Q2 next year.
Okay, Q2 next year. That kind of ramp up, plus the AI and Optimus stuff, must require enormous investment. What did they say about CapEx? Capital expenditures.
Right. They expect CapEx to be around $9 billion for this current year. But they specifically signaled it will increase substantially in 2026.
Substantially? To pay for?
All of it. New production lines for the AI ships, for Cybercab, for the Tesla Semi, and for Optimus.
So this really circles back to the margin question, doesn't it? Are they basically saying they're willing to sacrifice near-term profits almost entirely, shifting the whole financial model away from relying on, quote, hardware-related profits?
Towards an acceleration of AI, software, and fleet-based profits?
Yeah.
Yes, that seems to be the explicit trade-off they're making, trading today's car margin for the potential dominance of tomorrow's autonomous platform.
Which they seem to believe is like an infinite money glitch, if it works.
That's the kind of potential they're talking about, yeah. The revenue from a massive autonomous fleet could dwarf current car sales profits, which logically leads into the governance discussion that came up.
Right. We need to touch on that impartially. There were comments about leadership structure.
Yes. The CEO talked about needing a sufficient voting stake in the company, specifically mentioning wanting something in the mid-20% range to ensure strong influence over the company's direction. He explicitly linked this to the long-term, potentially world-changing nature of the AI and robotics work, even mentioning the robot army potential.
Okay. And concerns about external influence.
He expressed concern that large institutional investors, particularly index funds, often just follow the recommendations of proxy advisory firms like ISS and Glass Lewis. He was critical of those firms, viewing their influence as a potential risk to executing these very long-term, perhaps unconventional strategic goals.
So making sure the company stays focused on this massive, risky AI pivot, even if it looks strange to outsiders in the short term?
That appeared to be the core concern expressed, yes. Ensuring continuity for the long term. Hashtag tag outro.
Okay, so wrapping this up, what does this all mean for you, the listener? I mean, Q3 shows Tesla's juggling incredibly well, managing huge global volume, record cash generation, but using that strength to pour resources into this radical transformation.
Yeah, the whole company's risk-reward profile now seems tied directly to whether they can execute on unsupervised FSD and manufacturing Optimus at scale and on their timeline.
It's a huge bet.
It is, and it loops back to the sheer scale of compute they're building.
Yeah.
Which leads to maybe a final thought for you to consider. Management talked about the autonomous fleet itself as a compute resource.
How so?
Well, imagine a future with, say, 100 million Tesla vehicles on the road. If each one has about a kilowatt of high-performance AI inference capability on board,
Okay.
that's 100 million kilowatts. That's 100 gigawatts of distributed computing power spread all over the globe, always on.
100 gigawatts.
Yeah. So the provocative question is, what happens when you have that kind of decentralized, massive computational power? How does that change the tech industry or even society in ways that go far beyond just ride-hailing or driving assistance? What else can you do with that?
That is a fascinating scale to think about, building a global supercomputer, one car at a time. Okay, thank you for joining us for this deep dive into Tesla's Q3, where automotive scale meets AI ambition. Definitely keep exploring this intersection. That wraps up Tesla's Q3 2025 earnings recap. From record free cash flow to ambitious plans for robotaxis, Tesla continues to be a company at the intersection of technology, innovation, and risk. Thanks for listening to Know What You're Investing podcast, where we decode the world's top companies, what they do, how they grow, why it matters. See you in the next episode.